Now, we're lucky to have with us a specialist in terms of the commercial real estate world. So we're going to talk a little bit about people wanting to get in the commercial real estate. And we have an expert with us, and that is Simeon Papailias. And he is, of course, with Royal LePage, the commercial division. And he's also a member of Real Pro Canada. So, Simeon, welcome to the program.
Good day, and thank you for having me.
All right, let's talk about your personal background because it's pretty extensive, and I think it gives confidence to people when they know that you yourself have been active in the commercial real estate. It's kind of like anything. How do you buy a home, from a realtor that doesn't or hasn't, bought their own, right? So let's tell them a little bit more about you.
My parents are both entrepreneurs, and they've been in business for self their whole life, and naturally, I've been taught the fundamentals from a very young age. As far as what priorities are, cash flow is, and how to measure it, and how to leverage it. I guess I was 23 years old when I acquired my first commercial property.
So just a few years ago.
Just a few years ago. But it was a result of getting a business that led to the real estate transaction.
Right.
So again, it's due to my background, my family's background in business, that opened my eyes to the possibilities of commercial investing, and it is very, very lucrative if you do it right. It can be very, very costly if you do it wrong. So working with the right professionals and assembling a team of experts, I know because I hear the show all the time how much you push a team of experts. There's nothing more important. And in this case, it would be, you wouldn't even make it halfway if you don't.
Very good. Now, how does the real estate differ between commercial and residential?
The major difference is the use.
Okay.
So a commercial real estate investment, it's easy to say commercial real estate and kind of encompass everything, but I can give you just a prime example from my experience.
Yeah, please do.
When I look at a building that's a freehold building, a freestanding building, and let's say it hosts a restaurant, any franchise or any mom and pop restaurant, doesn't matter, but it's a restaurant.
Okay.
When evaluating this building, if I want to buy it, because let's say your favorite Italian restaurant is in that space, and they pay X amount of dollars per month, and it makes sense to buy it for X amount of dollars because the return and the cash flow, everything works out great. But when evaluating an opportunity like this, this is now a single-use building. So in the case that your favorite Italian restaurant turns sloppy and it closes down, how easy is it to rent that back out? How easy is it to convert it? What is the cost of conversion? What does that do to your overall investment? Where does 5 years of a healthy investment, if you have to spend $500,000 or $1 million to turn it around, well, what did that just cost you?
Right, okay.
So, and then you can compare that to buying, like for example, commercial condos that can be offices, that can host a multitude of tenants, which lowers the risk significantly.
So if one doesn't pay or one goes under, of course you still have the other ones that are still...
And you can replace them easily because the space is not such a niche market to fill.
Right, okay. Simeon, you make it sound so simple, right? Because this is what you do day in and day out.
And that's just it, because we've done it. We've made mistakes. My father certainly has made mistakes.
Yeah.
I've lived through them. As a family, we lived through them. And my whole family is all entrepreneurs, mostly restaurant and hospitality owners, hotels, restaurants. Some are into shipping and receiving. So I've seen a multitude of business dealings and commercial ownership opportunities and how different they can be structured. And I've seen a tremendous amount of mistakes being made and the impact of those mistakes, which can be crippling.
What's the difference when we're talking financing between a residential and a commercial? How does it differ?
A residential mortgage you can get with as little as 5% down, for example. Why? Because the bank knows that if something does happen, they can sell it in the flip of a switch.
Okay.
Because there's a huge housing need. It's guaranteed by Canada Mortgage Housing or Genworth or one of the insurance companies.
That's right.
Anybody who needs housing can buy it. So you're actually targeting a very huge net, which is the whole population.
Right.
And from those who's looking for a home. With commercial, it's a little bit different because the type of use dictates the risk. And the riskier the investment, the more single the use that I was touching up earlier, the tougher it is to get financing.
So the banks look at it differently as a result.
They have to analyze it on a risk basis and a mitigation basis. So basically they're saying everything is hunky-dory. What happens if you fail? What do I do? So basically, you're looking for the average larger commercial investment. You're looking anywhere between 30 and 50% down. I have seen things as low as 20% in very hot AAA locations where there's very little risk. There's very little that can change. For example, a boardwalk, downtown Chicago, where if you open a door, money falls out of it because of the population alone.
Right.
So there's less risk involved. But I mean, if you're looking to put up a small plaza in an outskirt of a suburb where you're trying to enter a new market, you're obviously going to have to put a lot more capital down. But the risk is a lot higher, and the reward is a lot higher. So if you develop a new plaza in the outskirts and you successfully get your tenants in there and everybody's trucking along and the economy is picking up and you get your Timmy's, your Starbucks, you get a couple what we call anchor tenants,
stores, tenants,
which could be a Home Depot. It depends on the scale of the project.
Yeah, of course.
But once successful, you have multiplied the value of that land by about 200, as opposed to 8% per annum on a residential investment.
Very true.
So it's risk and reward go hand in hand.
Absolutely. The greater the risk, the bigger the reward.
And that's just it.
Let's go down to the people that could be listening that say, you know what, I've gotten and dabbled into the residential game. I'm ready to take it up a notch. So what is it considered? How many doors is it when you're getting financing? When you go from a residential, so let's say they start off with a home that has a duplex or a triplex or a fourplex, they still can get the residential financing component for that. But how many doors is it then, Simeon, when it goes to, now it's commercial financing? Is it over 5?
I believe it's 5 and up.
Okay.
So at 4, I believe you're still at the residential level.
Okay.
5 and up is now commercial financing.
Okay.
And again, you're not going to see a major change there from residential mortgages to commercial mortgages. That's not where you're going to feel it the most.
Okay.
There, I believe you need 20% down.
All right.
The financials have to make sense. So, for example, if it's 5 apartments or if it's 15 apartments, depending on what you're purchasing for, the rent roll, which is the sheet that explains the square footage, the rents for each unit, etc., have to cover and give a certain amount of ease to the bank that there is income coming, because now they take the income approach as always.
So they take the amount that you're getting in terms of rent, and then they minus all the expenses to run the actual building, and they look at that, make sure that there's a nice healthy plus.
That's correct. That's absolutely correct. Or else you shouldn't be buying it anyway.
That's right, exactly.
So if you're looking at going into that realm of real estate, I call that more investment real estate, just in my head, but it is commercial. It is commercial investing.
No, but I respect that. I mean, it's really an investor hat that you're wearing. You're taking it up from the one-off basis or having some rental properties. You're kind of taking it up a notch.
That's absolutely correct.
And Scott McGilvery, I mean, he always says that one of the most important considerations, whenever you're analyzing a property, and whether you're doing it on a small scale or larger scale, it's all about cash flow.
It is 100% about cash flow, and I've been lucky enough to see Scott a few times with his outfit. They put on some tremendous events to educate people. His model on how he assesses properties is fantastic as well, and it's dead on. It's 100%. So cash flow is king in the investment game. And basically, when analyzing these properties, the only difference between hiring a professional to help you and you being on your own is you don't know what you don't know. And that's because there's no secrets there. The roof is the roof. You can have a home inspector take a look at it. But did you ask the lawyer the right questions? Did you ask the seller the right questions? Did you look at how long the leases are, how long they've been there? What's coming up in the municipality that you're buying in? Are they changing the bus stop, which is making it a gold mine today?
Could be they changing the route. That could make it completely the opposite.
Completely the opposite. So you just have to look into things and work with people who have experienced the drama of a disaster property before.
Simeon, we always talk about doing due diligence. I mean, it doesn't matter what you're doing, whether you're buying a car, whether you're buying a residential or a condominium to live in. You do your due diligence, and that's why you hire the right people to do so. But on the commercial realm, that due diligence is even more significant. And that's why closings, when we're talking typical residential, we're like 30, 60, 90 days. But with commercial, it can be significantly different.
We're talking 90, 180, 365. It just really depends on
the size and the scope, eh?
The scope of the project. Okay. Absolutely.
So remind our listeners then, because of course, when we're talking about financing, you had made a great point. You want to use people that are pretty savvy in that world. So I know Real Wealth Group, of course, is a perfect example where they're available to help people, whether it's the residential, but also the commercial world. So our listeners can go to realestatetalkshow.ca.
I've definitely had run-ins in the past with Real Wealth, and they're a fantastic group to work with.
Okay.
Tons of residential deals have gone through their offices. Commercial deals, I mean, they have a great group of experts, and I know them at every management level in that organization. and it's a fantastic group to work with. So absolutely no doubt.
So again, to our listeners, visit realestatetalkshow.ca, and there's more information on Real Wealth Group that they can achieve there. And also, Simeon, for yourself, I know our listeners and viewers are going to say, okay, I want to get a hold of this guy. How do they do so?
The best way to contact me is via email, and they can reach me at Simeon, Simeon, at reccanada.com, or you can call my cell directly.
Because you pick up.
Because I do pick up, and I trust they won't be crank calling me. It's 416-791-0075, or at the office anytime, 416-443-0300.
You are a wealth of information. And boy, oh boy, congratulations on all the work that you're doing, the success that you're rightfully, you're deserving of. So good for you. And of course, we're going to have you back.
Thank you very, very much. And good luck to all the listeners.